Welcome, everyone. Thank you for joining. My name is Connor Kitko from the team here at YCharts, and joining me today is Michael Batnick. In addition to his role as Director of Research at Ritholtz Wealth Management, you probably recognize Michael from Animal Spirits podcast, What Are Your Thoughts, and The Compound and Friends on YouTube, and his blog, The Irrelevant Investor. How are you doing today, Michael? And are you holding up better than the markets right now?
I'm way better. I'm like only 5% off my highs.
That's pretty good.
So, yeah, I'm doing okay.
Excellent to hear. So we are about to get into this discussion, but a couple of housekeeping items quickly. Any questions that you have for Michael or for YCharts, you can use that Q&A function at the bottom of your screen. We'll be answering those throughout the conversation. We'll do a quick dedicated Q&A at the end as well. And very common question is, can you get a recording of this webinar? And the answer is absolutely. We will be sending that recording out to everyone who registered tomorrow. So check your inboxes for that. And finally, please keep in mind that the content of this webinar is meant for educational purposes only. It's not intended to be used as investment advice, nor is YCharts or Michael Batnick acting as an advising party regarding client funds in any way. Disclosure is done, so now let's get into the good stuff. We're going to talk today about some of the biggest public companies in the world and in the US and how they're affecting the market and our portfolios. We'll look at some interesting data that adds some context to the current pullback. We'll talk about market cap weighted strategies versus factor weighting or smart beta or even direct indexing. We'll talk about the merits of, I saw you perk up at that one.
Yeah, I was like, smart beta. What year is it? We're like rewind back to 2016.
It goes by many. I was actually reading about like how I've been using these words incorrectly for a little while. So we'll get into all that. The merits of investing even more money in stocks like Apple, Microsoft, Tesla, Amazon. We'll talk about historic market performance if these mega caps or large caps weren't part of the S&P 500. And we'll also compare all of the investable, mutual funds and ETFs that have exposure to these names or that avoid them altogether. So let's set the scene a little bit here. These are both percent off high charts, and Michael, obviously an 18% drawdown in the S&P is pretty bad. And obviously it's going to make headlines when the largest stocks in the market are down 20 to 45%. But are the mega caps, are these largest companies where investors should be focusing right now? And if not, what other sectors or asset classes do you think should be receiving the blame?
Well, I don't know where else. I mean, there's a lot of places you could focus your attention, but prior to the most recent events of the fan mag names rolling out of bed, it was actually incredible. And Ben and I have been talking about this on our show for like months now, that could you imagine something healthier than all of the stocks that were trading at nosebleed valuations, like crash. And before they were down 80%, they were down like 50, 60. So all the names, right? Zoom, Teladoc, Robinhood, DocuSign, whatever. And the market wasn't blinking. The market was making new all-time highs while these names were being cut in half. And now we know that that wasn't sustainable and that it was only a matter of time before these names were going to get hit. And now they are.
Yeah. And I think it's an interesting point comparing names like Teladoc or Zoom, where if you are a passive investor or maybe the average person didn't have a ton of exposure to those names, but now that's shifted where the average person in a passive ETF is really feeling the sting, right?
It shifted rapidly. We were talking about like what were the most obvious signs of the top, and we're going to spend a lot of time on that next week. And obviously all this is hindsight, but I'm pretty sure at the time people were like, wait a minute, Zoom is bigger than ExxonMobil. Like, I'm pretty sure that doesn't make sense. I think that everybody was like shouting from the rooftops, like, this doesn't make any sense. I don't care if we're staying home forever. This just doesn't make any sense. Now, Exxon is 13 times larger than Zoom. So the speed at which this happened is jarring and alarming. And the Dow is, I know like the Dow is like the boomer index full of value stocks, but I think this was a thing that was also like hard to foresee. When you say like the S&P, well, now it's getting worse. Yeah, the S&P is down 18, 19%. We're starting to feel the pain. And in 2017, 18, 19, all the focus was, well, if you back out all the FanMag stocks, right? What would the S&P have done if it weren't for Apple and Microsoft and they contributed, 90% of the returns or whatever it is? I'm looking at a chart. I'm using All Reliable. This is the comp table section of Y charts. I'm looking at the S&P 500 and I'm scrolling through the names of year-to-date total returns. And the first, I don't know, 25 names are all either energy. There's like a few materials in here. We got some boomer stocks in here. What would the S&P 500 be without these names?
It's an excellent question. I mean, if there was nothing holding up the market right now, or you're just saying even over that long term, these staple names.
I'm saying like the year to date. So we've got like Occidental up 100%. That's not such a big one, but Exxon and Chevron are up each like 40, 50%. Those are each, I think, $400 billion market cap companies. Like those are big names. Procter & Gamble's holding us up, United Health, Johnson & Johnson. And these are the names that nobody wanted anything to do with, understandably so, over the last decade.
Yeah. Yeah. And like you said, I mean, it's shifting so rapidly. And I guess it is a bit of a silver lining that if you do have, I guess, the boomer index following the Dow, or if you've always preferred that value, large, stable company, then I guess it's working out for you, right?
Yeah. Yeah. So
Okay.
I'm looking at like ratio charts, also using Y charts of Amazon to the S&P 500. And all of the outperformance going back to the spring of 2018, it's all gone of Amazon, all of it. If you look at Facebook, which is obviously, which was a monster stock during the FANG years, all of the outperformance of Facebook going back to 2015, 7 years of outperformance gone. You've got Amazon in the deepest drawdown of the last decade. And the people are feeling this. I know we're going to get to this in a little bit, but like these are a huge portion of the index. I think it got as high as 25, maybe 30% of the S&P. I think 25 sounds right. These are like 40% of the Qs. So these are, even if you're not a stock picker and you're just market cap weighted, these are bringing you down.
Yeah, definitely. And I think that, you've made the point, we're going to get into some of this. So right now we're looking at that FANG-M performance research from Ed Yardeni relative to the S&P with and without those names included. So if you're just looking at the S&P in blue, excluding FANG-M, you'd be a little bit worse off. But looking at that red line, you see how FANG-M returns are more volatile. And like you said, coming off the table pretty rapidly here. And now we'll talk about that last point you made, what percent of the S&P 500 did these stocks account for? And we'll get ahead of myself. Going into COVID-19, we saw that they were between 18 and 19% of the S&P. And then it peaked at maybe a little bit more than 23% by this research. And now we're coming back down. But overall, like the long-term trend is just this makeup of the S&P is going through the roof. And go ahead.
I think the thing that is so interesting about this is it's just a re-rating of these stocks. There's no fundamental deterioration. I should say Netflix and Facebook are their own stories, right? There is certainly a lot going on over there, but Apple just reported its best March quarter ever. AWS is, I think, at a $74 billion run rate, or maybe that's Microsoft Cloud. AWS might be at a $90 billion run rate. These things are still growing with their top line at 35, 40%, which is the good news. The potential bad news, or not the potential, the bad news is that because inflation is where it is, because interest rates are where they are, investors are re-rating these stocks. And these are like gravity, right? The way that like the Fed funds rate is sort of gravity for the economy and interest rate market. I think you could say the same thing is that everybody is taking their cues off of what mega cap tech is doing. And if their multiples are coming down, well, you see what's going on with Coinbase and Peloton and all those names as well.
Yeah, exactly. And so when you say that, like looking at where this per market cap share was, where it's been, and now it's retracing, is there a level at which it's healthy or it's appropriate, or can it like
who knows? Your guess is your guess is as good as mine. I don't know. What I would say is, given that they're still growing so much quicker than the market, I don't, it's hard to see it falling too much as a overall percent. Like, I don't say they continue to like fall faster than the market. But the market is not favoring growth anymore. It's favoring earnings and cash flow. And these are like monster cash flow earnings type of companies, but they're in that bucket. So they're getting sold.
It's a good segue to the next point here, as we're talking about kind of what is pulling down the market. What is that factor to be looking at? This is an analysis from a previous blog post of yours, Michael. So dividing all S&P 500 stocks into deciles by price to sales ratio. And what do you make of this move over time, where now it looks like even relatively less expensive stocks are beat up just as bad or more than the most expensive stocks in the index?
Yeah, I think that we could. I think that price to sales is in the penalty box, right? I think that nobody is valuing companies off of revenue anymore. Revenue growth doesn't matter if money's coming out the back door. So I am surprised to see this, given that we know that value stocks are holding up better, but value stocks don't trade in price to sales ratio. So I'm not surprised to see this metric showing this. If you broke this down by other fundamental ratios, I think you would see it. You would see a different looking chart.
Understood. Yeah. And so I personally have been seeing that as well, with the move to the dividends, cash cows, that kind of preference right now, wanting some real income. I also
lastly, sorry to cut you off. I also looked at this chart, but I've rounded a year. So not what's the price to sales ratio today, but what was it a year ago? And it showed a little bit like the most expensive decile a year ago was like blown to smithereens. That was the big outlier. But other than that, there was really no discernible difference. But the stocks that were the most expensive a year ago based on price to sales, I think it was down like 39 or 40% or something like that.
Wow. Yeah. So, it's just, again, so here's a question. That willingness for investors to just buy in at those valuations, and obviously post COVID-19, the market went crazy. It wasn't really a problem because we had returns to back it up. Do you think that was in part driven by like investors thinking, wow, the market sold off, this is an opportunity, I need to get in, and it really doesn't matter what price I pay?
No, I think what we've learned are how important interest rates are to investor psychology. And when money costs nothing, you are willing to subsidize money losing companies that are in rapid growth mode, that one day might pay you back, right? If money costs nothing, what's the difference? You get your money back today or in 5 years. Obviously, there's like some sort of discount rate that you're going to use, but the lower it is, the more rope you have. And in a low growth world, prior to the pandemic, like people were paying up for it. And so it's just one story. It's one story, which is inflation, interest rates. I don't want to get paid tomorrow. I want to get paid today. And so management companies that are being sloppy with their cash flows or with their hiring or expenses, investors are done. You had years of free money to figure out a business model, a path to profitability. It's over. If you haven't figured it out, investors are no longer subsidizing like what we're going to deliver in 3 years. That's it. It's over.
Yeah. And when the growth is potentially slowing now too. So it's like I think it's being hit from both angles, if that makes sense. Like you're not valuing the growth as much and the growth is slowing. And now we're seeing people, prioritize other things.
Yeah, I mean, and listen, I have no idea what's going to happen in the future. But it took a while for investors to get accustomed to buy pullbacks, get rewarded. Buy pullbacks, get rewarded. And for the first time in a very long time, it's buy pullback, lose 50% more in 3 days. Right. And so the idea that we're going to potentially go back to that mentality, I think people are still maybe in denial. Now it's possible that it comes roaring back. I mean, oil went negative. Anything's possible, but I really think that we're just in a different psychological environment, and it's got to play itself out. I don't know, when and where it ends. But all right, why don't we keep going?
Yeah, yeah. So this was also from your analysis back in February, but we've updated it, and this trend has just extended itself even further. Small caps, or not small caps, but the smallest of the large caps, right, are getting beat up considerably worse than those largest stocks in the index. And yeah, again, we've said it before, it's maybe not a size problem that's going on. There's probably some other factor that's really, growth that's affecting the S&P. But this is interesting nonetheless, just to see how, even the largest stocks are down 19%, let alone 40% for that bottom 50 of the
Yeah,
S&P 500.
yeah. I think it is a size problem because you've got the Russell 2000 in a 30% drawdown. It's only 2% above its pre-pandemic peak. Um, but then, and I don't really know what to make of this because, or I don't know how to square the circle, but like you look at the equal weight index and you would expect it to be getting killed relative to the cap weighted, and um, it's outperforming. It's down 14% year to date. Um, the S&P is down 18 and change.
Yeah, and that could, I mean, that equal weight is that equal weight index is overweight to things like energy right now, probably.
Well, it's well, I guess the way to explain this is not just that, although yeah, because energy is still a very small component, but the number of names represent a bigger portion. So they are being overweighted to the market cap, but also what's being underweighted are the FanMag names, which the last time I checked, the average drawdown there was a lot. Even the meat.
Yeah,
So we've got some outliers because Netflix is down 70%, but even the median drawdown for those names is like 30 something percent. And so if you're for the last 10 years, if you were not equal weight tech, you were basically short and you had no chance of keeping up with the market. And this year, for the first time in, most of our professional careers, it's the opposite.
right. Yeah, and we'll see, like you've hinted at a couple times, like who knows if that's going to be the case for the next 3 months or the next 3 years. Like, is tech going to come back into favor? To be seen. But let's continue working through this. A little comedic relief here. We are living in a market cap weighted world. So much of the best practice with investing, especially for new investors these days, buy SPY, buy a passive market cap weighted ETF. Certainly the first advice that I got when I was, starting a 401k and a brokerage account. And now I think with this, what you just said, the largest stocks down so much, we'll move on to the next slide just in case that's giving anyone a headache. But let's look at some other ways to be weighting or structuring, an index or a portfolio. So I'll avoid the smart beta verbiage at risk of being made fun of again. But Michael, giving recommendations, like, is there something to be considering outside of market cap weighting right now?
Well, I don't give recommendations. I'm staunchly anti-recommendation. But wow, I'm just
Yes.
I'm just
Yeah.
staring. So sorry, forgive me, but it was rewind like 12 months, 24 months, 36 months. Like when is value back and how? I think maybe I'm misremembering, but what we were saying was like you need a different interest rate environment. right? In a low growth, low interest rate, low inflation world, people will pay anything for growth. How and when does that change? Well, now we know, right? Now we know. But uh look at value and low vol, which is, they're, I guess they're cousins. Um, they're doing just fine.
Yeah.
So I think the takeaway from all of this, and there's like a million takeaways, is diversification works. And sometimes not only do you not see it working, but sometimes it's annoying. Sometimes it's like downright like painful, or at times excruciating. And everything in life and investing is relative. Think back to like the latter half of 2020, 2021. All of us, everybody who's listening, had people in their lives who you would consider less intelligent than you, certainly when it comes to the market, who are making you feel very, very foolish about your own portfolio. Even people that have been doing this long enough that like, know that buying ARK in 2021 was not like the right move. It's still, at some point, like we all second guess ourselves. And now on the way down, you may take some comfort in knowing that, yeah, I'm down, but man, I'm not down as much as that person.
The FOMO is so strong, right?
Yeah. So it's like FOMO on the way up and thank God on the way down.
And just, looking at this visual again, so we're looking at factor weighted indices here, and looking back at that drawdown in March of 2020, it was the S&P 500 value that got beat up the worst. And
Right.
Then growth was down by 6 points less. And the S&P itself down 33 and change on a percent off high basis. But now looking to the right side of this
Apple's
chart.
Apple's down 4.5% today. Holy
Michael,
shit.
Michael warned me today. I'm sorry if I get distracted during the call with something on my screen. And here it is, 4.5% after. So that was, they said good earnings, but poor guidance. Was that the story there?
I don't remember what their guidance was, but man, oh man. All right. So the NASDAQ 100 is about to close in its worst drawdown over the last decade.
Stings.
Is that right? Yeah, it's worse than, it's going to be worse than 2020, which is hard to believe. Yeah, I'm sorry. I cut you off.
All good. No, all good. I just wanted to quickly draw that comparison between what we're seeing right now, where, it's again, you said value was holding up. Like there was so much exuberance for growth because it didn't draw down as much. It went highest, the quickest post-COVID crash. And now, again, everything comes back down. Like you said, it's like gravity, especially for those growth names.
So the NASDAQ 100's in a 30% drawdown just about. And the Russell 1000 value is down 12%. I mean, that's a big difference. So I was looking at this the other day. You could like easily make ratio charts on Y charts. And if you're not making ratio charts on Y charts, like what are you even doing? But looking at value to growth, we're at like multi-year highs for small cap stocks. The Russell 2000 growth divide, or the Russell 2000 value divided by 2000 growth, it's gone this way for years. And now we're at multi-year highs, I think back to 2017. And even large cap, all of the underperformance of large value relative to large growth going back to the start of the pandemic has now been reversed. All of it. Wow.
It's similar to that, the Warren Buffett, the Berkshire versus ARK chart, tortoise and the hare has been, so many people have been talking about that, but yeah, you might as well have decided the exact opposite 2 years ago, right? No difference to you either way.
Wow.
So let's roll on. Quick, while Michael's in disbelief, a quick commercial for this recent analysis from Y Charts. We're talking about this real impact of mega cap stocks on your portfolio and the market. And if you want to download this research, we're about to start going through these visuals. Head to go.ycharts.com/megacap stocks. Something to add, Michael?
Last 11 billion. No, sorry. Stop.
Okay, so now we're getting into some of this research from Y charts. And the first thing that we looked at was investors' true exposure or hypothetical exposure to these names, which are down, 20 to 40% right now. So, Michael, first quick question, just a sanity check on these funds utilized, these 5 Vanguard mutual funds. Do you think that the typical investor portfolio, how do you think it compares or contrasts to this? And I guess I'll say an individual who's using a professional advisor.
Yeah, this is it. I think it's a pretty good representation.
So we've got,
I mean, just look at the flows to Vanguard total market funds and, BlackRock, whatever. It's just a relentless buying. So yeah, this is fairly representative. I mean, this is the market, right? We are the market.
Yeah. And then, so to compare that to the bar chart on the left, like, do you think that these percentages are eye-opening, or would you have said, yeah, that's about right for a 60-40 portfolio? 7.5% would be in those large cap or mega cap names.
Well, so this is a conversation that we've had with clients over the years that maybe had felt FOMO about not owning these names. It's like, you own these names, right? Like, it's 40% of the NASDAQ 100. It's 23% of the S&P 500. We're there, but we're doing it in a way that's, responsible. Sounds like, too high and mighty, whatever, but like we're there. We're just not picking them and buying and selling. But yeah, so these are not, this is not news to me to see it this way, but to see it this way is some really nice eye candy.
Yeah. And I not shown here, but we also looked in our white paper, we looked at like target date funds, and it was something crazy. Like even someone who's retiring in 5 years. So it's a 20, or it might've been the 2030 target date fund. It was like 8% in these mega cap names. So a soon to be retiree. And then going out to that 2060 target date fund, it was like 12, similar to this all stock, like 12 or 13%, which makes sense if you understand target date funds, but it is still jarring to be like someone who's retiring in 3 to 5 years and they're, almost 10% of their savings are invested in these names. Okay. So let's talk about, you said like the answer is usually you already own these names. You already own, as we just showed on our bar chart, the stocks that have largely been driving the market. But we added another element to our analysis by asking if you did invest a little extra money into just an individual name, what would that look like for your historical risk and return profile? So, you said when someone asks, should I buy Tesla? Should I buy Amazon? You largely, the answer is you already own these stocks, but what's your reaction now to seeing, okay, if you added 5% to Apple, to Microsoft, to Google, you're going to improve your returns and maybe only marginally increase your risk over time?
Yeah, just go back 5 years and you're all set. I think one of the things is that over the years, people tend to like, this is an overgeneralization, but people that own these names, like they own a lot of it. Right. So I think like you're more likely to find somebody who's like 20% of their portfolio than 5%. And maybe I'm sure it didn't start out that way. Right. Mm-hmm. But people weren't dying to take a little bit off the table. Right. Why would I sell my Apple?
Yeah. It makes sense. Looking at this in a little different way and even a more risky way to structure your portfolio. If you said, yes, I'm still on a 60-40 portfolio, but all of that 60% equity is invested in these mega cap stocks. Wow. What's, again, the comparison is wild to say 26% annualized if I had invested in an equal weight basket of mega cap names versus 8% annualized going back 10 years if you were just in that regular 60-40 portfolio. But like the drawdowns you would have been experiencing the whole way probably make this unpalatable for most people.
Totally.
Yeah.
Yeah, these are all stunning charts, and but look at that decline. Look at that orange line.
Yeah. It would just be, I mean, yeah, we're all complaining, we're all sore right now, but imagine if that was your portfolio, that you had no market cap weighted, you were just all in these mega cap stocks, and you had been, following the hype for so long. So that
I
was
think also
the
problem is that people that might have had a portfolio like this, that they migrated towards Peloton and Zoom and DocuSign, right? And like the next potential 4 horsemen or whatever.
Yeah. Yeah. And I think that people thought, I thought that Zoom was going to be one of those horsemen, like I thought that Zoom was going to be up there with in our daily lives, the way that Apple is, like, carrying around in your pocket. Like,
yeah. And you know what this doesn't show? So what we're showing here is the 5 biggest winners, right? But what about like PayPal, for example? That's not in this chart. Or Nvidia, that's now down 50%.
Yeah. Nvidia actually is in here. So
is it?
When we say it's in that basket, yeah, Nvidia is. But yeah, it's just insane. And Nvidia is like a new entrant to this this cohort, right? Like over the last 2 or 3 years, market cap just went, or its price and market cap grew so much that like Netflix, you might as well not even include in this conversation. Netflix is tiny compared to.
Yeah. What is it like? What is it? 80 billion now? I mean, hold on. Let me just look at Y charts.
It's not even, I don't even think it's in the top 25.
It's 75. Very small.
Yeah. Tiny.
Oh my
and
God.
Still,
yeah. I know this is like, nonsense and whatever, but like fun with charts and et cetera, et cetera. So Netflix is 75 billion right now. Zoom was $75 billion, like not even a year ago.
So let's get on
Zoom
to.
Was, yeah. Sorry.
No, go ahead.
Yeah, no, it's just crazy. Like in November, Zoom was $75 billion. Like it's just the speed is just, so now Zoom's 25, but Netflix is as big today as Zoom was like 7 months ago.
Right. It's wild. It's because you think of, Netflix being in that FANG moniker, like it occupies a certain amount of real estate in your brain. But then when you compare its size, just a straight up comparison on market cap is, maybe we shouldn't be focusing on Netflix as much. It makes the headlines because we all watch Netflix, but
right.
Yeah. So here's a little, talking about these mega cap names that have really contributed historically to the index's growth, but now are its main contributors in terms of this drawdown. We looked at historically, a hypothetical S&P without Apple, without Amazon, without Facebook, and then that light blue triangle to the bottom left of this scatter plot is the S&P without all of the mega caps shown on this chart. Standard deviations on our x-axis and total returns on the y-axis. And again, I'm curious to hear your reaction to this. We see that Netflix, by excluding it, had like the least impact on the S&P, but that's because it is so small. But then if you were to exclude something like Apple from the S&P's historical returns, you're talking about versus 15% annualized, you're going down to 13% annualized. Excluding all these mega cap stocks.
Yeah.
Go ahead.
So what's the takeaway here?
I think the takeaway is just that it is scary to think about how much these stocks are drawing down right now. But historically, if you hadn't had any exposure to them, or if the S&P didn't include them, returns would be half of what we've benefited from over the last year, or the last 5 years, excuse me. So it is this, love-hate relationship of, so much of the market growth we owe to this small cohort of names, but so much of the pain we're feeling right now, the same culprit.
Yeah, because when Zoom went from, what did I say, 150 billion down to 25, all of these names could have disappeared in the market. The index investor would not have felt it, right? Like one Apple is probably all of the stay-at-home stocks, probably more, So when this thing falls like it is right now, it's down 5%. We feel it.
Yeah. And it's I guess a similar concept to talk about Tesla, like earning a place in the S&P 500 just a year and a half ago. Like those, that volatility wasn't showing up in my portfolio until it became part of the S&P 500. And now you have a new problem to deal with, which can be great for you over the long run, but in moments like this, definitely stings a lot. Here's another way to look at some of that. We just looked at that 5-year return. Now we're looking at on a calendar year basis. So again, just another way to illustrate this performance when looking at that leftmost set of bars, 2022 year to date. And this is actually as of February 28th. So this is stale data. Apologies for that. But by excluding the mega caps, you'd be better off right now. Of course, hindsight is 2020, but it is interesting to see just on a calendar year basis, even the S&P 500 benefits from all of these names year after year. The picture hasn't changed that much.
Look at 2020. I mean, I think this is probably when it reached its fever pitch.
Right.
In terms of the big stocks carrying the index.
Yeah. I mean,
and I guess look at those purple lines. 32%, 18%, 28%. Okay, we're giving some of it back. It's not fun. Some people are giving a lot of it back, but I think that this is what it is. This is not unexpected. No, I'm not saying I predicted it or any, but up 30, up 18, up 28. And now we're down 18. Yeah. Sounds about right.
And things things had to cool off at some point, but maybe it's just the pace at which things are cooling off that's really rattling.
It always is. I think people are like, I could handle a pullback. I get it. I know what risk is. I understand. But when you're thinking about that, you're thinking about that absent the event that's going to cause the sell-off. You just think that instead of the S&P 500 being at 100, it'll be at 80. No big deal. But without considering that the thing that's driving it down to 80 is by definition scary and bad and freaks people out, because otherwise they wouldn't be selling.
Yeah. Yeah. Let's talk about a little bit. Another analysis that we had in our white paper was looking at, mutual funds and ETFs, particularly the passive index tracking variety, and just trying to see how much of these funds, how much the inclusion or exclusion of large cap names, Apple, Amazon, Tesla, how much has that affected their risk and returns? And so this is, I have a hard time making sense of this comparison, but looking at, we use the YCharts fund screener to filter down for ETFs and mutual funds that had exposure to our cohort of mega cap names, and then those that had no exposure to any of those names. So you see on this left hand, looking at AUM weighted 5-year total return, an active fund with mega caps, with all mega caps as some of its holdings, has performed the best. Passive with those mega cap names, the second best. And then that continues to slide down, active without mega caps, passive without mega caps. And I just can't justify the expense ratio element where I guess it makes sense that, the passive funds have the lower expense ratios, but active funds that avoid mega caps are the most expensive on an AUM weighted basis.
Mid and small, especially, like tend to just have higher expense ratios than large. So I think that's all that is. And active without mega caps, I guess at that point, you're not even, you're talking, you're talking mid and small.
Yeah, that's fair. So, but I guess it is still interesting to make that comparison of the returns that those active small and mid cap funds have posted versus, the relatively high fees that you're paying for.
I'm actually surprised that the active with mega caps outperform passive with mega caps. That's surprising me.
Yeah, we would. So if you download the white paper, you can access this screen and see all of the funds that make up these different cohorts using the YCharts fund screener. But yeah, it would be very interesting to dig into this further and see what categories or what asset classes are kind of like, affecting these numbers. I think the small caps is an excellent point. One more look here. These are likely those drawdowns that we saw in 2020, but looking at max drawdowns over the last 5 years. We talked about that. We saw it with the size chart earlier, and you've talked on your blog about small cap names are usually beat up the worst in times like this. And this is an interesting way to, again, make this comparison of love them or hate them, like the funds that have exposure to these mega cap names kind of have tended to hold up pretty well also.
Yeah, in 2020, I think that these names fell way less than the market.
And what do you think? I guess this is a question of like that mentality during that time. Like you would have expected a flight to safety, but it doesn't make sense that the growth stocks, tech stocks, are safety by most people's standards. So what was the mindset, you think, of people, rushing into these large cap names when the market sold off in 2020?
Yeah. I think at the time, people just perceived Apple as like the 10-year of stocks. Like whatever I do, I'm not selling my Apple. And that mentality was pervasive and ubiquitous for the last decade. And I'm not saying that can't come back, but like, again, I think some people are still in denial. Apple's down 5% today. So I think that denial is being remedied, but yeah, I think I'm in like not disbelief or shock and awe. It's just like, wow, this is a material change in markets that most people just aren't used to.
Yeah. And I think there's, we won't get into all the behavioral finance elements of it, but I'm sure that there's something to do with witnessing, my generation, we're familiar with the 2008 crisis, but we didn't invest through it. And then now 2020, maybe we started to get a little bit more of a taste, but like you said earlier, it was like drawdowns get rewarded. And now here we are facing potentially a different situation for the first time.
Yeah, I think like the last thing I'll say is that with investing, it's not like touch a hot stove, you'll never do it again. Right? It's like, oh, I bought the dip. It worked. I bought it, worked. You did that like 10 more times. And then on the 11th time, it stops working, and then the 12th time, you're like, yeah, what's going on? And like, it maybe doesn't happen until the 15th time where you're like, okay, this really doesn't work. And so that mentality, that psychological makeup of the market, it takes time. And it's been happening for the last year and a half. We've been slowly going up less and less and down a little bit less. And now it's more.
Yeah. I can't remember who said this, but I read a quote of, what do you call a stock that's down 90%? A stock that was down 80 and got cut in half. It's like
that was David Einhorn who said that. And I actually saw a funny one today that was a play on that. This is from my friend Dan McMurtry His handle is at Super Mugato on Twitter. He said, "What do you call a stock that's down 70%? A stock that was down 90% and then tripled." So that's basically where we are. I mean, you see, if you look at Shopify earlier, Shopify was up 15%. You pull up the chart and the gain is like on the screen, it looks like tiny, but that's what happens. When a stock's down 80%, it doesn't take much to send it up 15%.
Yeah. I'm living through that on Chewy right now. Regretfully still holding
you're not
Chewy.
alone. You're not alone.
All right, let's get to some questions that came in. There are a few that we can ponder to wrap up our time here. So a question from Graham. Would SPX growth be an averaging play from here forward? The worst components likely got sold off more than remaining compounders. Reflexively going forward, any thoughts on minimal volatility doing the worst? Based on
what was the question? Was it S&P growth?
Correct. Yeah, S&P growth. Just given the level to which it's beaten up, like, can it go any lower, or do you think that?
Oh yeah. So I was looking at this today, and like, how low can it go? Well, in order to erase all of the post-pandemic gains, so not from the bottom, but from the top, in I think it was February 2020. Correct. In order to go back to where we were then, the NASDAQ would have to fall another 19%. So I'm not predicting that, but can we go lower? Yeah, I mean, I think, again, Apple is falling. I think like looking for capitulation is foolish. Like, as if you're going to know it when you see it. I don't think so.
Yeah.
Because if you just look at a chart of the NASDAQ 100 from 2000 to 2002 in the bottom, there was a lot of moments that like looked like capitulation, like, oh, that's the bottom. And then it bounced and then it rolled over again. And then that happened like 6 or 7 times. So if you're asking, like, can it go lower? Yes, it can always go lower. But what's your time horizon? How much risk can you stomach? Like, will there be opportunities for stock pickers, whatever? Yeah, absolutely. Are we there today? Maybe. I don't know. Maybe.
One other question from Tanya here, a little portfolio management question. Is rebalancing at these lows equally smart as waiting for recovery and then tweaking?
It depends what sort of portfolio strategy you're running. I would rather have certain like lines in the sand where it's like, all right, if the S&P does, falls 20%, we're going to rebalance. If it falls another 20%, I'm going to rebalance again. Mm-hmm. As opposed to like sort of waiting for some, I don't know, arbitrary all clear signal, the bottom is in type of thing. That's my opinion.
Gotcha. I guess this is an interesting one. Graham, I hope I'm understanding your question. You followed up with, question was more about the composition of growth S&P ETFs from here forward, less ARK-E and more core. Like, would you expect that this was maybe the question is, was ARK such a storyline that growth managers are going to have some adjustments going forward?
Okay. So that's interesting. So investors have been doubling down on ARK, or who knows if it's new money, coming in or whatever. I think that's over. And I could be wrong, but I think that ends this week. So we've seen, like, last Thursday was the biggest day of inflows for ARK on the year. I think that is over. I think this week, like, people started to like say, all right, I can't take it anymore. So we'll find out shortly. But I think that there is going to be little appetite for this type of thing for at least, I mean, that's got to be in the penalty box. You would think. I could be wrong, but yeah, I don't know.
They're certainly sticking to their guns, but I think it is writing on the wall for a lot of other people. Yeah. A question from Wheeler here, stocks like Roblox is down 30% after hours, after reporting, open positive. So it's bouncing between positive, negative. Is this just bottom feeding, or is it a sign that the stock may have actually bottomed?
Yeah, I mean, seeing intraday reversals like that is good short term. But when Apple's down 5%, I don't think anything can find a sustainable bottom. So if you're looking to catch a growth stock that is crashing, what I would do is wait for it to stop crashing. I know that might sound like obvious, but wait for it to stop crashing, and then it will rally and it will roll over again. Like this almost always happens, and maybe it won't, but at least wait for like one higher low. So if a stock goes down to 10, bounces to 20, rolls over to 15, and then goes again, 15 would be that higher low that I'm talking about. At least there's no urgency. And I know things look cheap, but Coinbase was $100. Coinbase was 300. On Monday, it was $100. So, I'm going to dip my toes. It's 45 today. You have to be careful. Things are moving so quickly. There's no urgency. So I got to wrap up if that's cool.
Yeah, absolutely. Thank you for taking those questions from everyone in the audience. Everyone who joined, thanks for hearing about this research from YCharts, and follow YCharts and Michael on Twitter. Check out the YouTube pages for more insights about, craziness in the market right now.
All right. Thank you so much. We are your biggest fans. So thank you. We appreciate it.
Thanks. Have a good afternoon, everyone. Good luck.